Welcome to Talk Tickers. If you're looking for where the real financial pressures are building, you really need to look at the consumer's wallet and specifically their dining habits.
Exactly. The casual dining model is under some really critical stress.
And today, we're going to move beyond just the headlines to really understand the mechanics of what's happening. We're going in on a regional example, the Chapter 11 filing by Cincinnati-based Taste of Belgium.
Right, using it as a microcosm for these systemic issues that are, just eroding margins for restaurants everywhere.
So we'll unpack the filing itself, look at the surprisingly sharp decline of what was a beloved regional staple, and then analyze the operational headwinds facing all these full-service chains.
And we'll get into the legal mechanisms, specifically something called subchapter V, which is really defining how these businesses restructure now.
Okay, so let's start with the event itself. What happened?
So on January 6, 2026, the restaurant group, Taste of Belgium Rookwood LLC, filed for Chapter 11 bankruptcy. This is in the Southern District of Ohio.
And it was a voluntary petition, right? And specifically under this subchapter V.
Yes, exactly. And the founder, Jean-Francois Flachet, he came out right away and called the move proactive and strategic.
Proactive. I always wonder about that word in this context. Is filing for bankruptcy ever truly proactive, or is that just, good PR for what is ultimately crisis management?
I mean, that's the multi-million-dollar question, isn't it? Proactive signals to customers and your staff that this is about reorganization, not liquidation.
Don't panic, we're still here.
Right. But if you look at the balance sheet they submitted, it tells a much clearer story of crisis. The company listed pretty minimal assets, somewhere between $100,000 and $500,000.
Okay, and the liability?
Against liabilities that could have run up to $10 million.
Wow. Okay, so that liability to asset ratio that's deep trouble no matter how you spin it.
It's a massive burden. Total secured claims reach $5.62 million.
And what's fascinating is where that debt comes from.
A huge chunk of it is federal debt. $1.85 million is owed to the Small Business Administration.
So pandemic-era financing.
Pandemic-era financing that they just could not outrun. Then you add another, $700,000 to a federal credit union and over $400,000 in priority tax obligations. It piles up fast.
And operationally, the picture is even more stark. I mean, this was a company that once had 11 bustling locations.
11 across Ohio and Kentucky. And over the last 2 years, they've closed 8 of them.
Including their iconic flagship location in Over the Rhine.
Yeah, that was a real gut punch for the local scene. They're now down to just 3 spots. The model was just fundamentally unsustainable at that scale.
So to understand the failure, you almost have to go back to the beginning. The origin story is pretty remarkable.
It really is. It explains the high hopes and, why the fall has been so disappointing for people in the region.
Right. This all starts back in 2007. Flachet literally brings a 120-pound cast iron waffle maker over from Belgium.
And starts in the back of a produce store at Sinley Market. It's the classic entrepreneurial tale.
And the concept just took off.
Immediately. They grew fast, moving from a market stall to their first bistro. They were serving traditional Belgian fare waffles, chicken, great beers, alongside American food that they've Belgianized.
They had real cultural cachet, too. I saw that in 2023, Flachet was inducted as an honorary knight by the Knighthood of the Belgian Brewers Paddle.
Which is incredible. So to go from honorary knight in 2023 to Chapter 11 in early 2026, I mean, the wheels had to have come off extremely fast.
And this is where the deeper analysis comes in. It wasn't just the pandemic. The problem started much earlier.
That's right. The external forces get the blame, but there were internal issues. Customer disappointment really started to surface between, say, 2016 and 2018.
Which correlates directly with their most aggressive expansion period.
Exactly. And the most common complaint you see in reviews from that time, declining food quality. Specifically, changes to how they made their fries.
That is such a fascinating detail. The moment a restaurant starts compromising on a signature, cheap, core item like fries, that's a huge red flag.
It signals a strategic failure. They scaled the operations faster than they could scale the quality control, and the customers noticed immediately.
And that loss of your core identity is so hard to get back.
Then that internal slip collides with these just crushing external factors. The pandemic, obviously, and then the inflation that followed, which just destroyed discretionary spending.
And then you have the structural problems hitting the whole sector, the massive shift to delivery and fast casual.
And the high commission rates from the third-party delivery services, we're talking, 30% sometimes? It just chips away at every single dollar on a to-go order.
Yeah.
Volume becomes the liability.
And you can't forget the legal pressure. There was an ongoing lawsuit from a landlord seeking back rent.
Right. So you have failing operations, spiraling debt, and litigation. At that point, Chapter 11 starts to look less like a choice and more like a necessity.
And this one filing, as you said, it's just a local story reflecting a catastrophic national trend.
It is a profound sectoral retreat. The rate of insolvencies is just stunning. In 2024 alone, 348 full-service chain locations shut down.
That includes huge brands. I think it was 134 TGI Fridays and 131 Red Lobsters.
And it got even worse in 2025. Over 70 major chains filed for bankruptcy in July of that year alone. That's the highest monthly total since the absolute worst of the 2020 lockdowns.
So let's get into the weeds on the core vulnerabilities. What separates a struggling casual dining chain from, say, a successful fast casual spot? It's got to be more than just inflation.
It boils down to margin compression from three specific headwinds. First, and this is the most critical one right now, is cost erosion.
Meaning more than just general inflation.
Way more. We're talking about surging labor costs from minimum wage hikes, rising rents on old legacy leases, and utility costs. All of this just aggressively depletes your equity.
And casual dining has such high SG&A costs, right? The big buildings, the high staffing ratios for full service.
Exactly. That structural cost base makes them incredibly fragile. The second headwind is the consumer shift you mentioned. Dine-in traffic is down, so that big, expensive building is underutilized. Rent becomes an anchor.
And people are shifting to value-driven places where you don't have to tip 20%.
Right. And the third factor is just plain old financial missteps. Taste of Belgium is a perfect example. They took on a lot of debt for that aggressive expansion.
Before the pandemic.
Then sales flatten, and suddenly you don't have the cash flow to service that debt. Many also failed to raise their prices fast enough to keep up with inflation, so for months they were selling food at a loss.
They traded profitability for value, and it was a bad trade.
A failed trade.
So that brings us back to the strategic response, restructuring. The fact that they used subchapter V is, I think, the most interesting technical detail here for anyone watching this space.
Oh, absolutely. Subchapter V is, people call it a mini Chapter 11. It was created under the Small Business Reorganization Act in 2019. The whole point is to cut administrative costs and speed up the process.
Which is huge for a business this size. They can't afford the millions in legal fees a normal Chapter 11 takes.
Exactly. So there are three key advantages. One, lower cost because you don't need a creditors committee. Two, it's much faster. A plan is usually proposed within 90 days.
And the third one is the real game changer.
It's the most important one for the founder. Subchapter V allows the principals, the owners, the chance to retain their equity in the new company.
Even if the creditors aren't paid in full?
Even if creditors aren't paid in full, provided they meet certain conditions. It's a true lifeline. It lets the entrepreneur keep the core business alive while shedding the unsustainable parts.
We should also mention the debt ceiling for this, because that was a huge deal.
A very big deal. Originally, the debt limit was low, but it was temporarily extended to $7.5 million. That extension was a game changer. It allowed a much wider range of businesses to use this streamlined process.
So moving from the mechanism itself to corporate governance, there's a big warning here for directors and officers about operating in what's called the zone of insolvency.
It's a huge fiduciary alert, because once a company is in that zone, management's duty is no longer just to the shareholders.
It expands.
It expands to the creditors, because the company's assets are now effectively the collateral for the people you owe money to. You have to prove you aren't just protecting the shareholders at the creditors' expense.
And how is that zone defined legally?
There are two main tests. The first is the balance sheet test, which is simple. Your liabilities exceed your assets. Legal insolvency.
Okay.
The second is the cash flow test, or equitable insolvency. That's when you're simply unable to pay your debts as they come due. If you hit either of those, you have to change how you make decisions.
Which leads to the classic pitfalls management has to avoid right before they file. I'm talking about actions that can be clawed back by the court.
This is where management teams get into serious legal trouble. You have to avoid any payments that could be seen as preferential. The court can claw back payments made to general creditors within 90 days of filing.
And it's much longer for insiders, right?
Yeah, it's much more serious for insiders. Payments to equity holders or company insiders, like a big bonus or a sudden loan repayment to the founder, could be clawed back if they were made within 1 year of the filing.
So if a founder knew the company was sinking and paid himself a $100,000 advisory fee 6 months before filing, the court could just take that money back.
Precisely. That money would be subject to a clawback and used to repay the creditors. These kinds of decisions can create significant personal liability for the board and management.
So the lesson here is that while this is a painful reset for the industry, Chapter 11 isn't necessarily a funeral. It's more like a desperate surgical operation.
And that turbulence, that desperation, it creates some very intriguing opportunities for capital. Which brings us to our next segment.
Right. This is not financial advice. This is where we talk about an outrageous but plausible trade idea based on the dynamics we've just uncovered.
And the premise is clear. This sector is undergoing a forced consolidation. That means distressed assets and discounted M&A opportunities are popping up everywhere, especially for cash-rich private equity.
So our trade uses that as a core assumption. We're going to execute a short position on a very specific type of asset, a highly leveraged regional fast casual burger chain.
And it has to be a chain that's burdened by high legacy lease commitments. The key here is we are betting against their inflexible real estate model.
At the same time, we go long on a specialized logistics or a last mile delivery tech provider.
And critically, this is not just another delivery app. We're looking for a provider that focuses solely on deep integration with restaurant POS systems to maximize capital efficiency. We're talking about minimizing the burn factor.
So the rationale is a pure hedge. We're betting on the collapse of the physical footprint versus the rise of the capital-efficient digital layer.
The short side is a bet on the failure of operators who are stuck with expensive, inflexible leases. That traditional multi-location model is just too costly for current consumer habits.
And the long side is a bet on the irreversible trend of off-premise dining, but with a sharp focus on that capital efficiency. The survivors coming out of subchapter V are going to be desperate to solve their high burn rate.
The market obsesses over top-line revenue, but the survivors will be the ones who leverage technology to slash their SG&A and labor costs. We're betting on the software solution, not the collapsing real estate.
It's a bet that consolidation will favor the tech integrators over the carriers of extensive empty dining rooms.
So to recap, we started with the Chapter 11 filing of Taste of Belgium, a business using the Subchapter V process to try and reset its operations.
We placed that event in the much broader context of the casual dining crisis, which is being driven by costs, debt, and these huge shifts in consumer behavior.
We highlighted Subchapter V as a lifeline that allows owners to potentially keep their equity while shedding debt, as long as they navigate the very tricky zone of insolvency.
And avoid those clawback pitfalls.
So if a successful reorganization requires a restaurant like Taste of Belgium to strip its menu back to what it used to be, to focus on its original core offering, and encourage high-margin dine-in business, what does that suggest? What does it say about the long-term viability of that highly leveraged multi-location high-growth model?
A great closing thought. We leave you to consider whether more and bigger will ever again be synonymous with better in this sector, or if the future only belongs to the specialized and the capital efficient, the ones who never compromised on the quality of their freights.